Can you flip a house with a conventional loan? By the end of this video, you're going to know if you can use a conventional loan and if it makes sense to use a conventional loan and what other investors are actually doing that makes a lot more sense. You might be tempted to use a conventional loan to fund your flip, but it comes with a catch. What if I told you traditional loans from banks are actually the worst options to fund your flips? In this video, I'm going to explain why most banks always say no to flips, and I'm going to show you some smarter options out there for you. Okay, so what is a conventional loan? Well, a conventional loan is given by a bank. It's usually backed by the federal government, and it's designed for long-term purchasing of a home, not for an investment property. The payments are amortized over 20, 25, or a maximum usually of 30 years that you make payments. They are heavily interest front loaded, meaning in the first 10, 15, 20 years, you're primarily paying compounded interest on that loan, meaning that every year you hold that money, it's not a straight 5% or 6% or 7%. You're actually paying compounding interest year after year of the loan that you're paying. So it's designed for people that want to buy homes and pay for them over a long period of time. If you have a home now, it's what you probably have. You have an FHA or a conventional loan. FHA loan is backed by the federal government. It's got some different programs. Conventional loans are usually purchased by the federal government from banks or from other banks, and they are a different type of loan, but they're still a bank loan designed for a long-term purchase. They are owner-occupied almost all the time. They require as little as a 3% down payment to buy the house. Their availability to you depends on your financial stability, on your credit rating, and on some qualifications of the house. But primarily it's about you, your credit score, and your financial strength. Again, a conventional loan is not federally backed like an FHA, a USDA, or a VA loan. Those are all federally backed loans. A conventional loan is offered by private banks and credit unions and lenders like that. Banks don't like to loan money on flips. Therefore, they don't want to use conventional loans for flip properties. Why? Because they're risky. If you think about it, they're going to loan money on a property that usually needs repair. Sometimes it's condemned, sometimes it's not lived in, sometimes it needs a lot of repair, and you might be a new flipper. And that becomes a very risky proposition for a bank. And banks are not in the business of taking large risks. That's why it's based primarily on your credit score and your financial stability. So if you go south on it, they can come after you and take the house back. They don't want to take back a house that's a flipped house that you never touched and it's not worth any money in the first place. You know, most flips wouldn't pass an inspection for a bank. And banks like to loan money on long-term, 20, 25, 30-year amortized loans so they can get compounded interest. When you borrow money for a flip, that's a very short-term loan. They don't like to loan money on short term. There's not a lot of money in simple interest for them. They make incredible wealth on compounded interest. If a bank does loan a house on a flip, they might consider it if you're going to turn it into a long-term rental. However, if you're doing this in your personal name, not an LLC, there's a limit to how many they will loan you. Typically, it's about 10 properties that they'll loan you. That's the max. You might say, well, Glenn, that's a lot, 10. Well, it won't be once you get started because you'll want more and more rentals and you want to put that in an LLC. If you want to learn more about that, make sure you just check out our channel. Lots of information there. You can learn about why it makes more sense to flip as a business in an LLC as opposed to using just your personal name. A conventional loan, if you were to get one, is only for the purchase price. It has nothing to do with any rehab costs or holding costs or buying and selling costs. Those costs you'll have to come up with on your own. You can do an owner-occupied conventional loan. I've seen investors that try and be sneaky and do this. They say, well, I'm going to live in the house. Well, you have to actually move in the house within 60 days of closing if you use a conventional loan, and you have to live in the house for at least a year before you can sell it. If you're somebody who wants to do a slow flip, you can legally do this. If you say, I want to live in a house for every 2 years, and I want to upgrade, I want to keep doing it that way, you can do that. It's a lot of hassle for some people to have to move every 2 years, frankly, but if that's something that you want to do as part of your overall investment strategy, you can do that. And you can use conventional financing to do it as well. If you want money to flip houses, conventional is not the way that you should do it. There's a lot of other ways that are a lot better. Let's start by talking about hard money lenders. There are a tremendous amount of hard money lenders available today. It's a group of people that get together. They usually form a small company that loans out money on the purchase price and the renovation, and they base the loan value on the ARV, or the after repair value. They'll give you up to 65% of the after repair value. They'll usually loan around 80% to 90% of the purchase price, and anywhere from 80% to 100% of the renovation costs on the property. One of the caveats is, on the renovation side, you're going to have to front the money up front to get the renovations done at certain phases. Then you'll get reimbursed for how much you put out. So there's a cash flow issue you're going to have to deal with. Now, we have a lot of videos on our channel. Again, you can please check out about how to do this. You don't have to use just one source, but if you're smart about this, you should find out ways to flip houses without using any of your own money. Again, our channel will explain that in detail. So hard money is the first option. The next option is using private money. That's my favorite. Amber and I have been using private money for almost 20 years, and it's proven to be one of the best ways we can have a win-win situation with people that we know and like, and new friends that we make, and new relationships. People get double-digit returns, and we give them the security and safety of having a mortgage in the property, having insurance so they're protected in case of any catastrophe that comes along, and I don't have to worry about filling out applications every time. These are people that just loan us money on the flips that we do, and you can borrow the purchase price and the renovation costs and the holding costs, and if you structure it correctly, you don't have to make any payments on that loan until you flip the house, sell the house, and at that time you can give them their principal plus interest. Therefore, you will help your own cash flow situation through the entire flip. So that's a much better way to fund your flip by using private money. And you can also use creative financing. Creative financing means these are creative ways you can partner with the seller. You can have the seller be the bank. You can do seller financing. There's a lot of ways you can get that done. Again, I keep saying in our channel are a lot of videos that'll go over a lot of this in detail. Please make sure and check it out. And creative financing is a way that you can get your deals funded without using your own money or without using hardly any of your own money. As I said at the start of the video, a conventional loan can work for a slow flip, but you're going to have to live in the flip. But here's what else you'll have to do. You'll have to make sure that you have the renovation money yourself or from a different source, because the bank will not give you that money. So again, I would make sure that you find alternative ways to fund your flips. Just know that conventional is out there and they're good for refinancing your rental properties and your long-term debt, but they're not great for short-term debt. Before you even think about getting any kind of loan, you gotta make sure the deal makes sense. Go watch our next video where I'm gonna show you exactly how to evaluate flips, how to determine what repair costs are needed, how to determine the ARV or after repair value, how to determine what's called your MAO, the maximum allowable offer that you should offer to guarantee yourself a 15 to 20% profit on a flip. You know how we built this? Through blood, sweat, and tears. Over 20 years of investing. We still do over 100 deals a year. We still use this formula and this system to this day, and I want to give it to you for free. So if the video's not here, check out the description below. I'm sure the link is right there for you, and I want to give that to you right now.